Hello there, Livewire subscribers, readers, and viewers. Welcome back to reporting season. And it's that time of year where all of the companies on the ASX, or most of them at least, are going to open their books and give us a snapshot on what's been going on. And this one is going to be particularly interesting just because of all of the events of 2020, the stimulus that came into the system, and the different operating environment. I've brought back Rudi Filapek-Vandyck, who's the editor and the founder of FNArena. Rudi has 18 or so years of experience analysing company results. FNArena have a fabulous database where they follow what all the brokers, so all the sell side analysts have in their numbers in their spreadsheet. So he gives us some unique data and perspective from that angle. And Rudi's going to talk us through his expectations for reporting season. We had a couple of great interviews with Rudi last year, which I'll include in the links below. But Rudi, welcome back. Great to see you. Thanks for your time.
Pleasure to be here. It seems like I've never been away.
Well, Rudi, let's get straight on into it. Straight up question. What are some of the most important things that investors need to be aware of as we head into reporting season?
Insofar, there is something like an unusual or an unusual reporting season. This is going to be a very unusual one. In a very short summary, we have perceived to be very high valuations for equities globally. On some traditional metrics, equities valuations have probably never been this high for at least 100 years. And on the other end, we had a very brief, very sharp, very brief recession in 2020. And the market is positioning for a very sharp recovery this year. And as a result of that is that we are probably looking towards one of the best reporting seasons Australian investors will have ever seen in their lifetime. And the irony here is that prior to the events from 2020, the pandemic and the recession, corporate Australia was actually cycling some of the worst reporting seasons that we at FNArena have recorded in our existence. And they were definitely amongst the worst reporting seasons post GFC. So the irony here is that, and we might have forgotten that living in Australia, because we hadn't had a recession since the early 90s. But the irony here was that a recession is actually quite good for the so-called value aspect of the market, and it actually triggers a new bull market, and we are in the middle of a bull market here. So
from the depths of March 2020 to where we are now, you think a new bull market has been kickstarted?
Yes, it would definitely appear to be the case. And what is very, very important here is that some of the trends that we saw pre-March to 2020, for example, a decline in dividends in Australia in 2019. Corporate Australia had some of the worst reporting seasons globally, and definitely post GFC. It was one of the few countries where dividends started to decline, and that decline obviously accelerated in 2020. That's one of the major reversals we are about to experience in this month and in August this year. So 2020, from a dividend perspective, will be a bonanza. We will have the return of dividends for a lot of companies that had to wipe it away last year. Those who had to cut their dividends last year will see it increase. And just to give you one example, not this year, but the following year, bank dividend yields from current share prices should almost be back to where they were pre-pandemic. And that is quite a remarkable turnaround.
Yeah, we've read some analysis on our website indicating the same thing. So that sounds positive on the dividend front. Just keen to understand, Rudi, we had the RBA come out last week. Rates have been effectively pegged at 0.1% for the next 3 years, with more stimulus in the pipeline. How do you reconcile that backdrop from the RBA against what you're saying is effectively going to be a new bull market? It doesn't sound like we're in the healthiest economic environment and therefore conducive of corporate profits and bull markets.
That is definitely true, but if you look at the corporate profits, a complete different picture is emerging. And what is emerging here is that it's basically a similar picture as what we saw in 2009 after the bear market of 2008. Basically, analyst forecasts are too low. PE ratios give a not an inaccurate picture, and companies are more likely than not to surprise to the upside with their financial performances and with everything that comes on top, like dividends. And the combination of that will give this, or will keep the positive momentum going for the global equities. In January, for example, it looked like markets were getting a little bit overheated, and it might actually be time for a correction. But as this corporate reporting season draws closer, and in the US, of course, it's ongoing, the numbers are absolutely staggering, and they will look staggering by the end of February, I think. And that's why I said at the preamble, this is going to be probably the best reporting season all of us have experienced in our lifetime. And that's apart from the valuations that will keep a positive momentum under the markets, I think.
And Rudi, you also said in your preamble that a lot of people were saying the equity market looked, as in broad terms, looked expensive. Are there any specific sectors where you think there's likely to be outsized opportunities to the upside?
I think there's two elements to your question. One is the valuations itself, and I hope that investors are by now are aware that low interest rates basically create a higher valuation for equities, in particular for the growth and the quality segments, not so much for the value aspect. The other element is that we have to understand how price earnings ratios actually work to understand why markets look as expensive as they are today. And I think the best example to use for that is the experience of BHP in 2015 and 2016. See, when the BHP share price tanked to $13 briefly in early 2016, the PE ratio rose to 80. So that's a very high PE ratio. And at first instance, that doesn't make much sense because BHP had to give up their progressive dividend. The market was really punishing it, and commodity prices kept on dropping. So the profits would be cut quite dramatically, and the dividends. But the reason why the PE ratio rose that high is because the market was rightly assuming this is not going to stay forever in place. The recovery will be on the horizon. And of course, in hindsight, we've all seen that the recovery has arrived for BHP, and BHP has now tripled in share price. And the profits, of course, have gone the same way, and the dividends. Now, the share market as a whole is essentially in a similar position here. We had the drop in 2020, and we are now banking on the recovery of 2021. And that's why, by definition, PE ratios have to be high, and that's why they look as high as they are today. So the main danger is that recovery will not be as strong or as quick as the markets are pricing in right now, which, if you reel it back to the reporting seasons we've now seen in Europe, in the United States, and ongoing now in Australia, those reporting seasons for this point, this early in the year, are suggesting that PE ratios, that valuations are not too high for equities, and that they are justified by the fact that corporate results come in better than expected, and analysts will have to recalibrate their forecast to a higher level. So essentially, it's all about sustainability. Later in the year, we have to figure out whether it's sustainable on the back of that economic recovery that should be ongoing.
So, Rudi, you've said a lot of what happens is going to be, relative to where expectations are.
Yes.
That's something that we've consistently discussed with you over reporting seasons. Is the result could still be a profit loss, but if the loss is smaller than expected,
yes,
you can see the shares rally.
Yes.
From your observations and analysis on the database that you run of the sell side analyst expectations, could you give me specifics on some of the stocks where you think the sell side is most bullish or most bearish, or where you think the biggest adjustments are going to need to be made?
I think there's two elements here. One is that this remains a polarized market. And the irony now is that because we haven't discussed this, and maybe this should be discussed in a broader interview at another time, but bond yields in the background are having a major impact in markets behavior and in markets dynamic this year. And this year's reporting seasons will continuously evolve against the background of the bond market, whatever is happening there. And the fact that bond yields have been rising over the past half year or so has created a upside down dynamic in the share market. And what do I mean by that is that the yesterday's winners in the market, yesterday's super performers, the quality stocks, the technology stocks, the structural growers, they are now facing headwinds because bond yields have moved higher. And those stocks that couldn't catch a bid previously, the banks, the resources, the mining service providers, the cyclical industrials, they are very much in favor this year, and the bond yields are a key reason for that. Now, when you ask me about certain segments of the market, there's two interesting elements to note here. The numbers that have come through from European corporate profits and from the US look very, very high. In terms like in Europe, it's about 65% of businesses have done better than expected. In the US, it's around 80%, which is quite high. Now, where it gets interesting is that the reporting season we had in Australia after August, before this one, it doesn't get much airplay, but there are companies reporting in that season. That already gives us a little bit of an insight in how February can be. The number of beats, so to speak, is considerably higher than the average of all the basically than every reporting season we have recorded so far. On our calculation, 49% of all businesses that have reported between September and December beat market expectations. I'll give you a statistic so far because the February reporting season is quite young, but we've already seen a number of companies reporting. The number of companies that have reported better than analyst expectations so far in February is 70% in Australia. In all the years I've done this, I've never seen a reporting season starting off this high. So if those numbers correspond with what we've seen overseas, that's why I said at the very beginning of this interview, we might be at the very early stage of a tremendous reporting season, where most companies, if it's not 2/3, it might be close to it, will basically force analysts to revalue their businesses and to revalue the valuations for those businesses, and that all else being equal, bond yields, etc., should keep a positive sentiment in the market. However, and here is where the polarization comes in. Already from early observations in this season, I've noticed, for example, that a ResMed or an MCOR that have both done better than expectations have not been treated in a similar fashion as has been in REA Group or a James Hardie or as a Credit Corp and Pinnacle Investment Management. So, and Macquarie, which I found very, very remarkable. Well, Macquarie reported this week that in the United States, out of all the COVID winners, 82% has beaten market expectations over there, but they have on average not performed that well. And out of the COVID losers, so basically the banks, the cyclicals, only 50% has beaten market expectations over there. But they have in majority been treated better by the market. And I think that's the message for investors here. The likes of ResMed, CSL, car sales, all the winners from last year, they have to work harder, potentially for a lesser return in 2021. Of course, those long secular trends will not go away. It's just that for the time being, the market is very much focused on the losers from last year and potentially seeking protection from higher bond yields.
Rudi, I'm going to pick up on those comments around higher bond yields and how it's impacting some different sectors of the market. And last year, you actually told us that frustrated value investors would continue to be disappointed, which for most of last year was right. Of course, the last quarter, we saw that rotation into value. So from what I'm hearing there, does that mean you have slightly changed that view about frustrated value investors?
Yes, they're definitely having their moment under the sun right now. And I think it is plausible that they will have their moment on the sun for longer. In this context, it's good to point out that I'm still a believer that bond yields will remain lower for longer, that we will have predominantly low inflation, and we will definitely do not see the disappearance of the structural trends we saw before this year. It's just that in the way that the share market sometimes works, for the time being, all those considerations from last year are now in the background, and the market's focus is basically somewhere different. It never goes in straight lines. I think what I also pointed out last year to you is that the gap between the value part of the market and between the growth and quality part of the market had never been as high as last year. And I think such a large gap, the largest as we've ever seen since we started gathering data, that somehow had to correct. It can't just go in one direction. So what I think is happening is that we are seeing a normalization between the relationship between the valuation part of the market and the growth part of the market, but not the disappearance of growth for growth, if that makes sense.
Now, Rudi, let's get back into the analysis that you've been reading from the sell side, because it is where you spend a lot of your time. I was wondering if there was, some of the research that you've been reading, if you could pick out something that stood out as being particularly useful or insightful that you could share with our investors.
Yes, I sort of already gave that to you. I quoted that Macquarie research which they published, and I thought that was very opposite, and it's very important for investors to understand now that, for example, if you are James Hardie, or if you are Incitec Pivot, or if you are Emeco Holdings, or if you are Index, that you don't have to perform that well to get a big reward this year. The market is on your side. If you are ResMed this year, or you are Emcor or CSL, you have to work really, really hard, and you may not get the same reward as those companies I just mentioned. And that's what Macquarie picked up from the United States corporate result. And that's immediately what I already noticed in the early stages of this reporting season. The market is less interested in the companies that perform well and are supposed to perform well and always do well, because basically we already know that and we've priced that in. And we are now very much on the side of the ones who are really in dire straits last year, and that will see, all else being equal, a big jump in their dividends and in their corporate profitability, and that's what we're very much focused on this year. So it's good to understand that it's not necessarily anything wrong with the growth companies that everyone has in their portfolio. It's just that for the time being, that the market's focus is literally in a different spot.
Well, let's get into a couple of stock specifics. Are there a couple of names that you'll be following really closely and that you have high or low expectations for?
If it comes down, for example, to where the expectations are for the market, and I mean, obviously I follow my own companies, but analysts have their own focus as well. It's not a big secret that some parts of the markets are really going through a very strong operational momentum. And for example, the buy now, pay later sector is one of them. Discretionary retailers is another one. Housing related exposures, that is both on the side of a domain and an REA, as well as a James Hardie, CSR, and others, Brickworks. It's also, basically, there is this pent-up demand with consumer spending globally. and expectations to surprise are, on my observation, are predominantly and in a very large group based on companies who are leveraged to consumer spending. And that varies from a Babcock on one side to super retail, to Harvey Norman, to even the Woolies and various other retailers. Those are the companies that are often mentioned to do very well this year, on top of the usual, the normal candidates, which very much are including the banks here. People are there's now really building up expectations for the banks, and including the mining stocks. I mean, iron ore producers are still swimming in cash, and for once in a very long time, this season that also includes the energy sector, the energy producers. To which again, I like to add that I'm a firm believer that the energy sector is now facing a structural decline of the decade ahead. But it signifies again that the market often lives in the moment, and for now the prospects and the expectations for the energy sector are very positive. It doesn't mean that a stock like Woodside or Santos in 10 years time will be where they are now, but the chances are very much that in 6 months they might be at a higher level. And I'm very much focused, of course, in stocks that I own. And that those stocks include, for example, an IDP Education, which, to my surprise, has started rallying quite strongly. Probably also because it was mentioned by some stockbrokers as a prime candidate to perform in the season. And I've structurally moved away some of the money I manage from yesterday's winners into what I think might be this year's winners. And that includes stocks like an Aristocrat Leisure, a super retail, but also for the first time in a long time, I'm back on the Telstra board, and I actually believe that the whole Telstra example is one example of how a structurally challenged industrial that just can't make it work can still create shareholder value by essentially selling off the farm. And you will remember that last year I published a story on Livewire where I predicted that both AMP and Telstra would not see the next decade out in their format back then. Well, AMP is basically selling off the farm, putting themselves up for sale, and Telstra has now decided that that's the way to go as well. It means that we spoke earlier about rising bond yields. Another element that people should be careful for is that if they own dividend stocks, and if those dividend stocks have no growth under their belt, that means they basically are facing quite severe headwinds from rising bond yields. So you have to think about your usual REIT that only has a little bit of growth. So you might think you get your 6% yield, but you might face a 6% falling share price. So actually on a zero operation there, at least for this year. So my advice to people has been from January onwards to, if you are looking for yield or for income, you should look for industrials that pay dividends and that have more growth under their belt, and that can also be financials, of course. So hence, Telstra and the banks are back in focus this year.
Sounds like a bit of old school Australian share investing, banks and a telco.
Everything goes with ups and with swings and roundabouts.
Rudy, our readers love following a good statistic, and given we are talking about reporting season, and that is one specialty of FNArena, could you share an incredible stat about reporting season that's caught your attention?
I mentioned earlier the 70% of companies that so far in the season are beating expectations. That is a tremendous figure in an Australian context. We never do as well as the United States does in that regard. Another number I could mention here is that so far average price targets for those companies are up by 9.5% this month. In aggregate, they're actually up by more than 13%. If you know that it has never been higher than 7%. And those were the fantastic reporting seasons we had since the GFC. So this goes well beyond that again, further fueling into that sentiment that we are facing a very, very favorable February month. Maybe another statistic is that because we had so many dividend cuts, that the average dividend yield for the ASX 200 has now fallen to close to 3.5%. That used to be 4.5%, and at times when the market got really a little bit hot on the collar, 4%. On current forecasts, even with the dividends probably surprising to the upside, we may not get back to 4% until next year, not even this year. So there's still a long way to go until we get back to what we lost since 2019. But that won't stop the share market, of course, from taking the positive instead of the negatives. And it means we are growing. And that's everything the share market needs to know at the moment.
Right. Well, thanks, Rudi. I'm going to have a quick go at summarizing some of the views you've given us. Number one, you think we're in a new bull market. Number two, broker earnings expectations. The analysts need to upgrade those. They haven't been upgraded yet. So you think that's going to be generally positive for reporting season. Bond yields in the background having a big impact. So the winners of yesteryear are going to have to work harder for returns. And you think that value trade has got a little bit more to go in it. And from across the board, what you've seen the highest level of beats versus misses than you've seen in quite some time. So you think overall, with rising dividends, low expectations and consistent beats, things are looking pretty rosy.
And it will be a very polarized market in the end.
Well, Rudi, thanks for jumping on the call. For Livewire readers, every Friday on our website, we're going to be publishing a great bit of analysis that Rudi does, where he summarizes the stocks that have reported over the past week, whether they beat, missed, or came in line with analyst expectations. That'll be up under Rudi's profile on the website every Friday throughout reporting season. He covers over 300 stocks, so it's an amazing resource. If you enjoyed this video, subscribe to the channel. We've got lots more great content coming up, and give it a like. Rudi, thanks again.
My pleasure.